Hi, welcome to Mark in a Minute. Being from Denver, it's a lot of fun watching the Nuggets play. It's fun having a team that's competitive. So they have a tough series coming up, but hopefully they can make it to the finals. So investor sentiment, it's still really, really negative. We think that sets up for that negativity to dissipate as we go through the year and get that money back into the market. So we think that there's probably still more upside when that money comes plowing back in. The Fed meets on Wednesday. We think that they may cut their quantitative tightening, which will be a big help and set up a nice buying opportunity in the consumer cyclical area that's been really depressed because of it. And we have a potential home run stock that we'll talk about at the end. Big, big, big upside, and it's in the biotechnology area. The technicals. So we plowed through the 20 day, through the 50-day. We're up 18% off the bottom. So that's a big run. The next objective is the 200-day, which is about 2% higher than we are currently. Now, what will happen if we pierce back below the 50-day moving average? Our tactical model will give us a sell signal. We'll have to start protecting the portfolios again. The stochastic oscillator that we have is clearly way, way overbought. So the market needs to work off that overbought condition. There's a couple different ways it can do it by correcting a couple percent or just letting time pass. That'll relieve the pressure of that overbought condition. Now, here's the sentiment. So you can see here where 59% of the investors are still really negative. The high point recently was almost 62 back on April 2nd. So not much in the way of bulls around, a lot of bears. As I was saying, as this flips back to the other side, the bears become bulls, then the stock market will probably go up very nicely, either from a lower level or maybe it back and fills a little bit, and maybe we go from this level higher into the second half of the year. Not counting on that though. I would expect a little bit of a pullback. The CPI report, big surge in imports. So the imports really brought down the GDP numbers. So the imports actually lowered the GDP report by about 5%. So it's interesting though, the consumer consumption actually was a little bit weaker than we thought as well. That came in just under 2%. It's been running 2.5% to 3% for the last several years. So the consumer's been, reasonably strong, and clearly the consumer is weakening. This report was not recessionary, not at all, but there is, some weakness on the margin. As this flips the other side, you'll see the net exports flips, so it's less on the import side. It'll be probably pretty positive for the economy, either in the second quarter or third quarter. Now, this is the trend right here, the investment area. So people buying capital goods, generally speaking, that was up 3.6%. So over the last 3 years, so during the last administration, that area was flat to down. So this is a nice improvement. And as you've been following the news, you know that Trump's really been pushing the direct investments from foreign countries into the United States, or foreign companies into the United States, and also domestic companies to step up and build new plants here in the U.S. So this could be really positive, and consumer spending will probably come back really nicely as well. So there's a lot of writing on this page. So let me be succinct about this and hit the high points. The 2-year Treasury versus federal funds rate. So as you know, there's a high correlation between the two. The 2-year Treasury basically forecasts what the federal funds rate is going to be. So the Fed follows the 2-year, and you can see how closely this been is over time. As the 2-year goes up, so is the federal funds rate. right now, there's a 60 basis point spread between the two. So it's implying that the Fed will cut interest rates by about half a percent in the near term. So on the agency bonds, okay, this is important. On the agency bonds, there's a spread of about 1.4% on the mortgage-backed securities versus the 10-year Treasury. Now, the agency bonds are guaranteed by the federal government, so virtually there's no risk to them. And they generally trade more closer to half a percent to maybe 70 basis points above the 10-year Treasury. And right now, as I mentioned, they're 1.4%. So we see this as an attractive area. But because of what the Federal Reserve is doing with the quantitative tightening they've been on, it's pushed that rate up to a point where it's higher than what it should be, and it's choking off the housing market. So the federal funds, the Federal Reserve's balance sheet has been reduced. So in June of last year, June of 24, they reduced it roughly 60 billion per month. They reduced that to 25 billion per month, and then they reduced it again in March to about 5 billion per month for treasuries. Now they continue to put back into the markets 35 billion a month back into the markets of mortgages. So obviously the mortgage area is much smaller than the treasury market, and this is having some pretty severe impact on the housing market. So you can see here, this is early 2020. Existing home sales were running about 5.5 million per year. Now we're at 4. So that's down 27%. From the high here, it's down 42%. So this has been a colossal of a bear market in the housing area. They really need to let this market go back to being normal. It's really cutting off some really positive GDP numbers that we could be seeing, and I don't think it would be inflationary. The housing market. So this is kind of interesting. This is the new homes being constructed, the price of new homes being constructed, and this is existing homes. And you can see there's been generally a very nice premium for a new home versus an existing home. Now there's virtually hardly any premium at all. The new homes are going for, sometimes a little bit less than the existing homes, which is unbelievable. And it's just because the Fed has been way too tight on their quantitative tightening on the mortgage-backed securities and the mortgage markets. So this is D.R. Horton. This is the largest home builder, public home builder in the United States. So it was as high as $195. Now it's about $126. So big bear market in the housing stocks, right? We think that when the Fed halts what they're doing, mortgages will drop from nearly 7 to into the 5% range, which will fuel a lot of newcomers into the market. Existing homes will start to turn over, and the new homes will be sold at a more rapid rate, and probably you'll get that premium and new homes versus existing homes to come back again. So very good thing for the housing stocks. And we see that possibly maybe that's going to kick off here on Wednesday. If not, it'll come at some point in the not too distant future, because there's no reason for the Fed to be doing what they're doing. So some ideas. So as I spoke, the agency paper is really attractive. I mean, really attractive. It's at least 10% undervalued from where it should be, and that's a lot for a bond. So the PIM, this is a Putnam closed-end fund, yields about 8%, very nicely diversified, a very conservative fixed income instrument. We like that one. Agency mortgage REIT, so a little bit more leverage on these securities. So these are mortgage REITs that focuses only on the agency market. Agency and Dynex both yield about 16%. So because of that widespread, we like these a lot. And as the rates come down, you're going to see some capital appreciation kick in for these stocks. D.R. Horton, but there's other stocks that you could buy as well. So D.R. Horton is a good play. If the housing stocks go up, this is definitely going to go up with it. Other areas in the housing area, Lowe's, but there's other consumer cyclicals to consider as well. But we think Lowe's is really a nice company that has a fair amount of upside potential, especially when the housing stocks kick back in the favor, and likely will happen in the second half of this year. The banks really had good quarters, so we like the banks a lot. Bank of America and Citigroup are two favorites there. Meta had a good quarter. We like Meta, really solid company there. And we want to play autonomous driving. So Google and Tesla. Now, I would say to rush out and buy these two. Google has a little bit of cloud over its head with the Justice Department anti-monopoly practices, and then but I would buy it on a dip, and then Tesla the same way. I'd buy it maybe on a bigger dip, but that is a way to play this mega trend, and we talked about this last week. Mega trend in the commercialization of autonomous driving. Capital spending, we don't have a good idea, so maybe we'll just use an ETF there. We don't want companies that have a lot of international exposure. Most of them do. So we're still hunting for the best idea in the capital spending area of the markets. And then selectively in the biotech space, again, this tends to be a real undervalued space. Grail is our multi-year home run potential stock. This could be one of the best stocks in the space by far, as they get approval for their cancer test, which is already on the market. Anavex is our way to play Alzheimer's, and we think as we get closer to the end of the year, we think that their drug will get approved in Europe by the end of the year. And then Viking, we think they have the best-in-class obesity drug, both injection and oral, and we're going to see some data come out on the oral here soon. These two, Anavex and Viking, we think these are prime takeout candidates, really prime, especially Viking. We think that will happen this year. Well, we're pretty confident of that. So I've just known the management team for a long time, and I can tell on their tone on their conference calls that there's probably something that's going to happen here. Veru is another way to play the obesity market. This preserves your lean muscle mass. They've got data coming out here very soon, sometime this quarter, and we think that there's at least 100% upside, 100% upside in this name on that data. And Calcimedica, CALC, this is our huge home run potential. So it's tiny, it's extremely speculative. All right, they have $25 million market cap. They have $19 million in cash, so it almost trades in line with their cash. They have phase 3 data coming out in acute pancreatitis. Phase 3 data, that is a $1 billion market, and their market cap's $25 billion. But there's more to it, right? So they're in phase 2. They'll have top line results of the phase 2 here this quarter as well. And that's for acute kidney injury. Acute kidney injury is a $10 billion market. Yes, $10 billion market. There is no competition in this space, and the stock trades at a $25 million market cap. Novartis just acquired Regulus, RGLS. It's a play on the kidney space. It only had phase 1B data, so that's really early, extremely early, and they got bought out. So the stock went from basically $1 earlier this year to $8. So if you did the same valuations for Calcimedica, it would be a $37 stock. So it's roughly about $1.70 a share. So it's got huge upside. So don't put a bunch of this in your portfolio. If you buy it, do your own homework. But we see huge upside. We just put some of this in one of our tactical portfolios. We have it in our emerging healthcare. It is a really interesting stock to look at. So Again, how we're protecting the downside is through cash, stop losses, inverse ETFs when we need them. If the market breaks down, we're going to have to put the inverses back on to protect the downside. We still have some in the portfolios, but we'll have to be more aggressive about it. So if you ever need help, just ping us. If you want help with your investments, come to my website, Patrick Adams CFA, and also communicate that way. And sign up for a hard copy of Market in a Minute. It's the greatest value on Wall Street, free. So sign up for that, and we'll send that to you every week. Take care. Go Nuggets.